Hello there, everybody. Welcome, and thank you for taking time out of your work to be with us today and for being right on time. We appreciate that. This is Craig at Max Trading. I'm here along with Chris and Eusebio, and all of us are really glad to include you in the Max community for this presentation. This is a very nice trading community. Some of you will be taking a Max course during the coming month, which also gives you a lifetime membership in the Max trading system. So we look forward to trading with you for many years yet to come. The Max community is a lot of fun. There are tons of support and assistance available. Free trading workshops 3 or 4 times every month as you continue to improve your trading skills. As you know, the markets are always in a state of change, and boy, have we seen the changes lately. And new ideas can be really important, helping us meet the challenges that the markets present to us. It was more than 4 years ago now that Eusebio first began to see the need for a reliable indicator that would help us with the changing flow of price in the markets. And so he began to develop and to test what became the Max Enhanced Trade Format Indicator. That's a mouthful, isn't it? We just call it the ETF. It has proven itself over and over and over again as a very effective addition to Max Trading, and now we have added ETF to all course levels of Max Trading, so no matter where you jump into the system, you will have access to that indicator and learn how to use it, and all of that is at no extra expense. The ETF indicator, as well as the companion to it, which we call the companion or bias indicator, is that's the new directional indicator. Both of those can make a huge difference in trading results. And all of these things put together, proper training, correct price action analysis, effective indicators, these things give you a real chance at the kind of trading that can make a difference in your life. So all in all, it's a very exciting time to get in on the Max system, to learn how to use it, to take that big step toward meeting your goals. It could be that you just need a little source of extra cash every week, or you might be wanting to help out a friend or a relative or some loved one. There may be some worthy cause that has captured your attention, and you can imagine yourself being in a position to help. In fact, we have a few members who have joined us simply for that reason. They were part of an organization and they wanted to be able to help more. So Max is a great place to begin turning your dreams, your goals into reality. I think you'll be very glad that you chose to attend today or to take part by video. And of course, we also welcome those of you who are experiencing this presentation by video. And by the way, we do not expect you to simply take our word for it. We want you to see for yourself. And I'll be sending to you an invitation to attend a live trading webinar, which we have scheduled for this coming Friday, so that you can see on real-time charts the effectiveness of the Max trading system. Eusebio is the developer of ETF and also the companion, and that makes him an ideal choice to take us into the world of Max trading. He himself is a phenomenal trader and a skilled teacher, and what I appreciate most, I think, is his passion for helping others succeed. And I think you'll sense these things as you listen to him today. Eusebio, we so appreciate you taking time to do this for us today and all that you do for your fellow traders. I'll pass the microphone along to you.
Thank you very much, Craig. So hello, everyone. Welcome to this Max presentation. So before I start to present my segment of this presentation webinar, I always make a sound and video check. So do you see my screen and do you hear me well? I would really appreciate if you type a yes or a Y in the question area. Thanks, Constantine, Anthony, Vasil, Naresh, Robert, oh, it's go too fast. Sorry, I cannot mention everyone. So thank you very much. I really appreciate. So, and I see also a French, William. So before starting the Max presentation, so let me give a very quick background of who I am. So you have perhaps recognized with my accent that I am a Belgian trader, even if now I live in France for many years. And I am a full-time Forex trader since 2008. And since 2009, I have the privilege to be one of the Max instructor. But before being a full-time trader, I was in the IT industry. I am a former, past IT services manager for about 30 years, and the last 15 years of that career has been in the banking industry, which has given me the opportunity to be in contact with some bank traders. So, and this will be important for the rest of or for some part of the future presentation. So, but I have also a long experience of trading and investing in many other markets: the stock market, the options market, the futures market, and of course the Forex market. What I'm going to present today is some aspect of the Max trading system, and I will illustrate them through typical example of trade we may have. And I will just mention a word about the money management, or what can be achieved with money management when we use a trading system like the Max trading system. So, the Max originally has been created by late Dr. Jim Pruitt, known as Tiger by his student, because of a very strong temperament. But strong temperament doesn't mean a bad man. On the contrary, Dr. Jim Pruitt was a really nice man. And because he knew that his time was counted, his aim was to give as fast as possible to all his students a very powerful and reliable but also flexible trading method. And I like to say method instead of system, because it is not made of fixed and rigid and simplistic rules. And if the Max is simple and based on simple concept, so the rules are not always so easy to apply. They require some practice. They are not so difficult, but they require some practice. Indeed, there are some keys which are very important to become successful with the Max: work and commitment. These are the two most important success keys. Work, because the traders need to learn and understand and then apply correctly the concept and all the rules of the Max. And this requires some efforts, an important time investment and an important effort investment. And so the commitment to sustain that effort is extremely high. Of course, the aim is to make money through trading, but if making money is the only commitment or objective of a trader, chances are high that it will not succeed. So money is simply a tool to achieve other kind of objectives, and so the commitment must have a higher level. And this higher level commitment will help to sustain the necessary effort to develop in order to become successful in trading and to stay successful later in trading. But there are other skills which must also be developed: discipline, patience, persistence, concentration, confidence, and I like to add conviction too. Disciplines and patience. Why? Because as I will explain in a moment, so our Max trading system is based on rules. And in fact, rules represent sets of conditions we must we must wait for them to be fulfilled, and then we take an action in relationship with that set of conditions. And so the discipline and the patience are necessary to wait for all the conditions and without violating these rules. And the patience is necessary to wait for the appropriate conditions. Persistence. Persistence is also an important skill, because as I will explain again later, we don't have a 100% winning rate, of course. We may have sometimes, depending on the market conditions, several losing trade in a row. But as long as we see an appropriate trade opportunity, we have to take that trade and then handle the trade, whatever the end issue of the trade will be. So this is persistence. Concentration, because the Max contains a lot of details, and sometimes just missing one small detail can transform a potential winning trade into a losing trade. And so we need to concentrate on all the details we can see on our chart, but also outside the chart. I will explain in a moment. And then confidence. There are 3 levels of confidence a trader must develop. Confidence in the market. I mean the ability of the market to give every day enough opportunities to trade or to exploit. Then confidence in the max itself, in its ability to catch most of all these opportunities, and confidence in the trader himself or herself, in his or her ability to apply correctly the concept and the rules of the max. And this kind of confidence will be developed through practice, in fact. So, when it matters to trading method, it is important, I think, to define what a trading method is made of. And the first point I consider important is to define what are the movements we want to trade. And by movement we want to trade, I mean essentially how do we define a trend and movements inside a trend. Then we have to define, of course, when and how such a trend or such a movement will start. And we will consider for that several types of price patterns. So then once we get the possibility for a movement to start, once we get an entry setup, we have to validate that that setup is an appropriate setup for a trade. It's not because we have an entry setup that we have a trade. The setup must be validated under 3 types of conditions: technical conditions, risk conditions, and global context conditions, and sometimes other considerations. So, for example, some timing aspect during the day when we day trade, when we use a small time frame to trade. By global context, I mean all the elements which may influence the movement, the price movement in specific markets we are trading. And so in the global context, we will include, for example, some geopolitical events. For example, it's clear that for 3 years now, the Brexit influences the pound and the pound pairs. Other aspects of the global context are the news release, but also the daily decision by the central bank, and so on and so on. So all these aspects of macro and micro conditions so will influence the market, and we have to take that into account and to trade in agreement with these elements. So it's not because we have an entry setup that we have necessarily a trade. The setup must be in agreement with essentially the global context. Then once we are in a trade, we have to define how to handle the trade. This means how to possibly make a partial close of the trade, and then later a global close of the trade, how to add to a trade, how to adjust the stop loss along the trade in order to progressively reduce the risk we have on the trade until we have a risk-free trade, when the entire risk has been cancelled or removed. And once we achieve that step, a risk-free trade, then we can focus on how to optimize the profit we can extract from the trade. And then we have, in order to make a global close of the trade, we have to define so how a trend, or at least a movement inside a trend, can possibly exhaust. We can never predict exactly when a trend will end, possibly when it will reverse, but we can certainly observe when the trend is exhausting. This means that perhaps the price will range for some time and later the trend will resume, or perhaps the trend will reverse in a trend in the opposite direction. So all these steps are the steps we consider we have to define in order to have a trading method. And so this is what we do with the max. And so, but historically, what the term max means, in fact, max is an acronym Jim has defined for the following reason. The M stands for momentum. Indeed, we want to consider a potential trade when the price has enough momentum and enough volatility. And our entry setup pattern include that aspect of having enough momentum and enough volatility. Then the A stands for acceleration. This does not mean the price must accelerate. No, this means that while we are in a trend, at least with our max ETF standard level of trading, so we can add to the trade, we can make scale-ins in order to progressively increase the size of the trade in order to extract more profits from the trade, from the movement we are trading. And the X stands for exit. At some point, we have to make partial exits, one or several of them, and at some point, we will have to close the remaining opened trade. And so basically, the max is a trend following method. Before we introduce the ETF concept, so the max, the classical max, was considering so trend and counter trend in relationship with a long-term moving average. And so when the price was moving on the right side of a long-term moving average, we were considering to be in a classic trend. And when the price was moving in the opposite direction of that moving average, so the price going toward the moving average, so we were considering to be counter-trending. But with the max ETF concept, we have generalize the concept of movement in such a way that we no longer need the concept of counter trend. We keep only the concept of trend. You will see in a moment through some examples. And so with the max, we have also a very strict risk, trade risk management and money management approach in such a way to first of all handle the trade in order to minimize the risk we may have on the trade, and then to progressively grow the trading account in a safe way. And considering that the max is a trend following method, so it may be applied to any time frame, from the 1 minute time frame up to the monthly time frame, and to any market. So whatever the market you want to consider, provided so you can trade the instruments of that market if they have enough liquidities, so enough volumes. It is also important to understand what the max is not. The max is not a scalping system. We are not necessarily interested in catching just a few pips in the shortest possible time period. Sometimes we are forced to scratch the trade as if the trade was a scalp trade, but because there are reasons to close the trade when the movement makes no longer sense to trade that movement. So basically, the max is not a scalping trading system. It is not a news trading system. We don't try to catch these fast and large spikes the price sometimes makes when we have an important news release with an important surprise, a positive or a negative surprise. Because when the price moves very fast, you know also that the broker usually widen their spreads. And when we try to execute orders along these spikes, we have almost always bad price executions. And most of the time, many of these trades will end as losing trades. So we don't trade the news, but the movement after the news under specific circumstances can be traded with the max, of course. When we understand the nature of the news release, and when these news releases influence the market in a very important way, then the corresponding movement can be traded, of course. And as I have said earlier, the max is not an elementary buy and sell system with just a simplistic buy and sell rule. So, but I will illustrate with some example. So what we call an entry setup, so is a high probability opportunity based on, as I have just mentioned a few moments ago, so technical aspect, risk conditions, and the global context. I will explain so in a moment. On the contrary, what we call exit setups represent, in fact, not a way to predict what the price can do, if the price can possibly reverse. For example, we are never sure when the price begins to make a pullback if this pullback will be a trend reversal. But we can at some point so consider that when the price goes against the trade, we are facing a risk for the trade. And we need to have a way to quantify that risk. And when that risk becomes too much important, we have to decide what action we can take in order to reduce that risk. And this is what our exit setups are. And so we have several types of exit setups. We have exit setup based on technical indicators. We don't trade the indicator, but we use the indicator to pinpoint as fast as possible when we have these kind of risky situations. We use also exit setup based on pure price action, we may use a combination of both price action and indicators. We consider also some timing aspect, especially when we use small time frame, when we trade with the 5-minute time frame, the 15-minute time frame. You all know, for example, that when we day trade during the European session, the London close is an important event along the day when many positions are closed by the big boss. And so this is an example of a timing aspect. And then we have the concept of the movement invalidation. Because we trade movements inside trends, when the movement itself makes no longer sense to be traded, we close the corresponding trade. And so we have rules to define when we have a movement invalidation. And of course, when we consider a trend reversal. With our companion indicator, we can say when the trend is reversing. So, as Craig has mentioned in his introduction, so before using the ETF concept, we were facing some challenging with our trend following system. And and this is true with any trend following system, by the way, whatever the time frame. Example of challenges are the following situations. When we have poor price action, so small price movement, when we have tight ranges as we are observing these last months in all the pairs, so we have average daily range which are decreasing and decreasing and decreasing. So when we are facing such kind of situations, we must not expect to have big or ample trend, and so we have to adapt our way to trade this kind of smaller movement. Another kind of challenge we may face is sometimes the price may reverse very quickly, and we can miss an ample movement. Why? Because we use, of course, indicator to pinpoint as fast as possible a situation, a potential opportunity, but sometimes the price is moving too fast and our indicators, for example, moving averages, do not react fast enough. And so this may be a reason why we may miss some ample movements. And then, before we introduce the ETF concept, so we had to make the distinction between what a trend was and what a counter trend was, which was not very comfortable. I don't say it was difficult, but it is not comfortable. And personally, I have always felt frustrated to make that distinction, because for me a movement is a movement, and as long as we can define a way to trade a movement, so it makes things simpler. And so the lack of reactivity of some indicators was one of the reasons we had to make some improvement into the max. And there was another challenge we may face sometimes. It is estimated that nowadays around 70% of all the traders around the world are still using time bar charts. For example, a 5-minute time frame, a 1-hour time frame. So each bar has the same duration on the chart. So, but when we use such a time bar chart, we may have a lack of details inside the bar. If you observe even in a small time frame, the 5-minute time frame, for example, as long as a bar has not closed, many things may happen during that bar. And so we may miss some important details along that bar. So this is an illustration of what I was explaining just a moment ago, when we are seeing for many years now the average daily range so decreasing. This is the example on two major pairs, two typical major pairs, the euro-US dollar and the pound-US dollar. And we can see that during the last 9 years, approximately, so the average daily range is progressively decreasing. Of course, sometimes we have an important increase in the momentum and in the volatility, but they are mainly decreasing. And for the moment, for some pairs, the average daily range is very, very small. This is not only true for the major, it is also true for the other crosses. So this is a phenomenon we are observing in a rather periodic term. So, and so this is the reason why we have introduced that ETF concept. So in order to try overcoming all these challenges, in order to really adapt faster to the changing markets. it is important to understand the market conditions. And there are two types of market conditions we can consider. We can consider the long-term market conditions when we have a progressively decreasing momentum or volatility, so average daily range, or vice versa. Times will come when we will see again the average daily range increasing, and then we have also the short-term market conditions, for which we define, in fact, several types of what we call price modes. And we define the trend mode, we define the counter trend mode, we define the consolidation zone mode, for which we will have, depending on the type of range, a breakout, for example. We define also the choppy mode, and we define a specific price mode we call a spaghetti zone. And all these price modes represent the way the market is moving, and we have to adapt our way to trade, especially our entry setups and exit setups, based on these market conditions. We don't trade the price movement under trend mode the same way under tight consolidation zone mode, for example. And so, as Craig has mentioned, so the ETF concept, which helps to overcome all the difficulties, all the challenges I have mentioned earlier, are included in all our MAX courses. We have 5 MAX courses, but today we present to you 2 of them, the ETF Primer and the ETF Standard. The ETF Primer is a very simple, reduced MAX version, and the ETF Standard is our flagship course, which contains all the main concepts we have within the MAX. We have 3 other levels, more advanced, like the ETF Sum and the ETF Advanced, but I will not talk about them here today. But with the ETF concept and its companion indicator, in fact, with the MAX, we are able to trade many more movements. So we have many, many opportunities every day if we simply follow 2 or 3 or 4 pairs. We can trade larger movement because we combine together what is defined as a classic trend with a classic counter trend, and so we can be more defined, more accurate in the way to handle the details of the price movement, and so we have so many more opportunity per day, as I have just said. So just to give you an example of this concept and what we can expect, what you can expect about the MAX ETF, let me show you some recent example. This is a small glossary I will use in the example. MOE, M-O-E, means a momentum entry. XXX means a complete exit. MX is a scale out, a partial exit, so it corresponds to a momentum exit. SC corresponds to a scaling. So the SC is the opposite of an MX. MX is a scale out, SC is a scaling. R represent the risk we associate to a trade, maybe for example 1% of the trading account, and RRR means the risk-reward ratio. And so let me give you just an example. So this is an example on the pound CAD. It was a few days ago. It was a down movement. And on the chart we have, on the main chart here, we have our indicator. So we have, for example, our long-term indicator, which is still used because it may represent an important level of support or resistance. We can see in this example that this long-term moving average was resistance to the upside. The price has bounced off from that home base channel, as we call it, and then moved downwards. And then we have some additional moving average like this one, we call the momentum line, which helps to qualify the type of price modes we have with some other tools I don't represent here on the chart. And we have these 2 lines, yellow and orange, which represent our ETF lines. So this is the implementation of the ETF concept. And you can see that these 2 lines are very close together to the price action itself. It has a lag, but a very, very small lag compared to the reversal of the price itself. The lag goes from 1 bar to 3-4 bars, so a very small one. And these lines are extremely regular and not so sensitive to many of the pullbacks the price can make. But it is still not enough to define what a trend is. To define a trend, we have our companion indicator here at the bottom of the chart. And it is made of 2 lines, a slow bias and a fast bias. The slow bias is the line in green and red. And so technically, but on the technical point only, when the slow bias is red, we will consider short trades, and when the slow bias is green, we will consider long trades. But remember, I have said earlier that we have also to consider the risk aspect and the global context. And so if the global context is, for example, to short the pound CAD, we will only consider the short trade when our slow bias will be red. And we have a short-term or fast bias which helps to validate some types of, or some of the entry setups we may have. And so this is an example of an entry setup. So an entry setup is a specific type of pattern. We may have several different types of patterns at the very beginning of a new trend. We may have other later in the trend. But whenever we have such an entry pattern and the setup is valid on the technical point of view, on a risk aspect. The risk aspect, for example, contains the fact that we have to place a stop loss for the trade in order to limit the risk for the trade. Another limit is also the percentage of the trading account we associate with the trade. We use for that, so exploiting the stop loss size and the risk, the percentage risk, the position sizing concept in order to calculate the size of the trade. But whatever the size of the trade, we always consider the trade is made of 2 units. So 2 units may represent, for example, 10 mini lots or 10 lots or 2 lots. In such a way that later, when we get an exit setup, and an exit setup, remember, is a situation when we can quantify the risk is becoming too much important while the price is retracing, and we have to reduce that risk. And reducing the risk here consists in closing 1 unit. So an MX1 here represents closing one of the 2 units we have opened for here, the short ETF S&P MO. And this unit has got a profit of 40 pips. For the moment, I will talk only about pips. Later on, we have another exit setup which appear here, helping us to close the second unit, catching 43 pips profit. So in total, this trade has got 83 pips profit. But the profit in pips is not relevant by itself. What is important is the rework to risk ratio. And with an 83 pips based on 2 units and a stop loss of 20 pips, this represents a rework to risk ratio of plus 2.08 R. I'm using the R, the Van Tarp notation. R represents the risk. So with a risk of 2%, this would represent a profit of 4.16%. Okay? Vasil, for the moment, the MAX is not automated. The MAX is a manual trading system, but many of the rules can be easily automated. But not all. Some rules are a little more difficult to automate, but we have taken the option up to now to not try automating the MAX. Okay? Well, this horizontal red line represents what we call a max price level. A max price level, there may be several on the same chart, are price levels which may be supply and demand levels. So, and in some circumstances, they will be used to validate an entry or to consider an exit. So, and so in this case, we can see, for example, that the price was hesitating a long moment along that price levels until the price succeeded to break that level and resuming the downtrend. These max price levels are always produced every weekend, and they are valid for the coming week. For example, this weekend, the new max price level will be updated and will be made available. So tomorrow in around 24 hours. So this is an example of an indicator, technical indicator we can use for some of our exit technique. It is the stochastic of the RSI. And so we exploit several types of different patterns this indicator is using to pinpoint potential exit setup. It's not because an indicator is showing an exit situation that we will necessarily make an exit. It will depend what the price is doing. Once we get an exit setup, we observe what the price is doing in order to decide if we have to execute that exit setup. And so every action either an entry or an exit is always made with two steps. We have first of all to define either an entry setup or an exit setup. Then we have to define the level where we have to make our entry or where we have to make our exits. And then if the price follows through, we either open the trade or close one unit of the trade or the remaining position of the trade when it is an a global close situation. So this is an example of a typical max ETF primer, which is the most basic level of the max approach. So we have just a few entry setup, a few exit setup, no scaling technique. But now this same movement handled with the max ETF standard gives a result which is completely different. For example, here we had an earlier entry. This represents another types of entry setup at the very beginning of a new trend. And along the trend, we have our MX which represent partial exit. So whenever we make an MX, we close one unit. But in the meantime, you can recognize on the chart on some places here SC1, SC2, SC3, SC4, we have scale-ins. And so whenever we make a scaling, we add 2 units to the global position. Of course, we will also adjust the stop loss. We have rules to adjust the stop loss in such a way to control the risk along the trade. And what we observe along for many years now is when we catch a very ample movement with many scalings, 4, 5, 6, 7, 8 scalings, sometimes more. We don't have such a movement every day, of course, but it happens several times a year. More scalings we make, less risky the position becomes through the trade risk management we are using. This seems counterintuitive, but we prove that in our Max ETF standard course. The most critical period for the trade is the beginning of the trade when we have the price having moved not so much in our favor and when we have possibly made a scalings. And so this is the most critical part of the trade. We have to pay a lot of attention to all the details the price gives us. But later, when we have made several scalings, several MX, so it becomes much more comfortable, much easier, because there is no longer risk. At some point, we are risk-free, and as long as the trend continues to unfold, if we make our scalings and MX in the appropriate way, the risk no longer increases. On the contrary, we are looking more and more profits. And so we can see in this example, we had an initial entry, 4 scalings, 4 MX, 5 MX, and then the final XXX. When we have made the final XXX, we had 5 opened units. To close the units, we always use the FIFO rule. So when we make an MX, MX number 1, we close the 1 unit of the initial entry. When we make the MX number 2, we close the 2nd unit of the initial entry. When we make the MX number 3, we close 1 unit of the scaling number 1, and so on and so on. So first in, first out. Okay? And so this is an example of a trend like the previous example with the Max ETF primer, but you can see that with the Max ETF standard, the result is way, way more important. In the Max primer, the reward to risk ratio was plus 2.08R, which is still a nice result, but with the ETF standard and the scaling technique, we have been able to catch more than 300 pips for a nice 7.73R profit. With a 2% risk, this represents 15.4% profit in just one day with one trade in one pair. Consider if you can trade 2 pairs simultaneously. So this was an example of a short trade. This is an example when we have several max price levels with these white and orange horizontal lines. The color are not important. They are simply a way for me to remember which time frame I have used to pinpoint them. So this is an example of a short trade. So we had here 3 trades. A first trade here, which is called a safe and perfect move. It's first exit, it's second exit. Then a second trade here, which is called a short breakout remo, with its exit and partial exit and final exit. And then a third trade, which is called also a remo, with examples, again, a partial exit and the final exit. And you can see, for example, the final exit has been made when the price was bouncing off from these max price levels. The entry, on the contrary, has been made on the right side of this group of two max price levels. So, and this is the kind of result these three trades have given for a total of 1.21 R. But the same movement with the max standard gives something different. So we have several scale-ins and several scale-out during the movement, and even after this max price level, because as long as the trend stays valid, we stay in the trade, of course, and this produces a result which is more than 3 times larger than the result with the max ETF primer. So this is an example. These were 2 examples shown in the 5-minute time frame. This is another one with a long trade, this time on the pound yen. I will leave you discover the result. And in this example with the max ETF standard, you can see that a very nice reward to risk ratio, 13.2 hours. This is an example of a trend which lasts for several hours starting around the London Open. The London Open was around this area. And so this is a trade which has been taken after the London Open and which has been closed around the Frankfurt and London close. Here we are in a situation, a very special situation we call a true trend. And a true trend is a specific type of trend. But when this happens, and this happens between 2 and 4 times per week for each pair on average, so it happens many times during a week, so on average between 2 and 4 times. When we are in a true trend, we can predict with a 75% probability, when this true trend will exhaust. And we can draw on the chart a specific rectangle which represents in fact a time window inside which the trend will exhaust. I don't say the trend will end, the trend will reverse, but it will exhaust. What may happen is the price can range, the price can make a deep pullback, sometimes it can reverse, sometimes it can range and after that it can resume the up movement, but this will happen in less than 25% of the case. We have 75% success rate to see the trend exhausting. This means that in around 12 to 13% the trend will exhaust earlier, and in 12 to 13% it will exhaust later. This will depend, in fact, on a very important factor, which is the global context. Depending on the global context, and depending on the type of price action we are seeing, we can say for sure when such a true trend will exhaust earlier, and sometimes later. So, because when the context is strong, then we can stay longer, in fact, in a trend. So, these were examples in the 5-minute time frame, but we can trade also in higher time frame and other types of instruments. This is an example of a long trade here with one entry, an exit, a final exit on the crude oil on the 30-minute time frame. And you can see that the structure of the trade, it was a long trade, the structure of the trade is exactly the same as in the Forex for a nice 2.4 R reward to risk ratio. We never fixed, by the way, a fixed target profit. We never fix a fixed reward to risk ratio. We take what the market can give us. This is why sometimes we'll have a small reward to risk ratio, sometimes we will have an average reward to risk ratio, and sometimes we will have a big reward to risk ratio. The same up movement with the max standard would have given so additional scale-ins and exit, and you can see the result with the max ETF standard, so a 5.8 reward to risk ratio instead of a 2.4, so more than 2 times the result of the max primer thanks to the scaling technique. So, an example of an index, it is the Dow Jones Industrial 30 on a daily time frame, and during that up movement there were 2 max ETF primer trade. A first one here with an entry, an exit, a final exit, and then a second long trade because the trend was still a long trade, an upward movement, an entry, an exit, and the final exit. So 2 trades for a nice 6.13 R reward to risk ratio. but the same movement with the ETF standard, allowing the scaling techniques. So this was a unique trade with 3 scale-ins, only 3 scale-ins. 3 scale-ins is usually the number of scale-ins when the price is trending. So which happens between 2 and 4 times a week when we use a small time frame. Sometimes with less scaling, sometimes with more scaling, but on average 3 scaling. And you can see here, even if it was a daily time frame, so 3 scalings, 3 for MX and the final XXX for a nice 19, almost 20 to 1 reward to risk ratio. It was a huge profit due to the structure of the trend. And in fact, the reward to risk ratio will depend on the amplitude of the movement, how deep or not the pullbacks will be, and consequently how many scale-ins and how many momentum exit or scale-out we will be able to do. More scale-in, less scale-out we will be able to do without increasing the risk too much. In fact, we have to control the risk, remember, so we will get a higher reward to risk ratio if we have less possibility to make scale-ins, more necessity to make MX. So we will get smaller reward to risk ratio. But the point is not to necessarily get the highest reward to risk ratio, but always to control the risk we have on one specific trade. So this was the Dow Jones. But we can trade, as I have said, any types of financial tradable instrument. And as I have said, we don't have a 100% winning rate. We have, on average, a 75% winning rate, around 15% losing trade, and around 10% break-even trade. So we have 5 winning trades for 1 losing trade on average. But the advantage of the max is when we have a losing trade, the loss is always a small one. You see here a typical losing trade after an entry for a short trade because the trend was a downtrend. The price has moved temporarily in favor of the trade and then has reversed quickly. And so we have been forced to close the trade, the second unit of the trade, with a larger loss, never the stop loss. We try to never let the price hit the stop loss. All the rules have the aim to avoid to be stopped out on the stop loss. And so this trade has been closed with a small loss of 5 pips, which represent, due to the stop loss size of 23 pips, a reward to risk ratio of minus 0.11 R. This means a very small loss. Sometimes the losing trade will produce a larger loss. On average, a loss will be around minus 0.4 R, minus 0.5 R. So always less than half of our initial stop loss. And so this kind of loss can be easily recovered with just 1 winning trade. Because when we have a winning trade, at least with the max ETF primer, the average winning trade will be around 0.5 R and plus 1 R. For the max ETF standard, it will be usually on average more than 2 Rs, in fact. And so 1 trade will help to recover such a losing trade. And I have mentioned a very specific price mode, the choppy market, the choppy zone. The choppy market is one of the most difficult market conditions to trade. And we have several criteria to recognize when the price is in a choppy market. However, what makes the difference between a choppy mode and the other price mode, like the trend mode, the counter trend mode, and the consolidation zone mode, is the 3 last price mode I have mentioned, trend mode, counter trend mode, consolidation zone mode, can be recognized within 1 or 2 bars when the price enters or leaves such a price mode. When the price, however, is in a choppy mode, it requires many more bars to recognize it. It will require between 30 and 50 bars to recognize the choppy mode. But once we have recognized the choppy mode, and we have several types of criteria to recognize the choppy mode, for example, one of the criteria is the price itself is moving in a completely erratic way. But there are other conditions to recognize the choppy mode. But once we recognize the choppy mode, we can be sure that the choppy mode will last for many more bars, typically between 100 and 200 bars. But along a choppy mode, we will have entry setups. These entry setups are not extremely frequent, but when we have one, we have two choices, either to skip that trade or to trade that situation. And if we decide to trade an entry setup when all the conditions are fulfilled, of course, the technical, the risk, and the global market conditions, when we decide to handle that trade, we will have to handle the trade, to process the trade in an extremely careful way, in a very special way we teach during our courses, in order to optimize the profit we can take from that choppy mode and minimizing the loss in the case we have so very small movement and the price reverses very fast. For example, here we would have had an entry setup, for example, with this bar. This blue bar is an entry setup bar, but the price would have reversed, and this would have produced a losing trade, a small loss by the trade management technique, the trade risk management technique we are using with the max. So when we use the max, because we have an expectancy, a positive expectancy with the max, so we can apply, of course, the compounding process as the money management approach to grow the account. What is important is not necessarily to be consistent in producing profits with the max, because the max has a positive expectancy. But what is important is to be consistent in the way to apply the rules and the concept of the max. And when a trader applies these rules and concept in a consistent way, when he or she will be consistent with the rules, the procedure, the process, the trading process, the profits or the result will follow. And in that concept, the money management and its compounding approach will be extremely powerful. And so I will just show here some numbers. So when we start with a trading account of $10,000, for example, with a 2% risk example, and so we can see that even with a small reward to risk ratio, which is here a 2-to-1 reward to risk ratio. Remember, each trade is made, whenever we open a trade, we open 2 units. And so when we calculate the result of the trade, because of these 2 units, we have to divide the total number of pips by 2. And then the result by the stop loss in order to get the reward to risk ratio. So here I consider 2 hours reward to risk ratio made within one trade or several trades during the day. And if we trade every day, of course, this is a very strong assumption because it's not necessarily easy to trade every day, even for a trader who is using day trading. But let's make that strong assumption. We have to make some assumption to know what we can expect from the trading process. We can see that the trading account will grow nicely with the number of days. So here you have in that column the number of days, and so the way the account is growing, even if we consider some withdrawal from the account. So this is a spreadsheet we make available to everyone who wants to get that spreadsheet in order to analyze some scenario about the reward to risk ratio we can obtain, about the amount of withdrawal we can make every month, for example, or at every period. 21 is the average number of days for every month. So you can define in this spreadsheet any withdrawal period or frequency. So, and see how the account can grow depending on that consistent approach of trading with the max. So, just to make a small recap here, so the max courses are organized in 5 levels. The very first basic level of the max is the ETF primer course, which is a very small subset of the max, just to give you the opportunity to see if the max is something you can consider in your trading process, and to observe also, to make the conclusion if we are legit to teach the max or to teach a trading system. Then we have the max ETF standard course, which represents our flagship course with the most important concept within the max, essentially the scaling technique, but also some important concept like how to handle the news release, and many other points. And between the two levels, we have the Max ETF Lite course, which is a larger subset than the primer. Once a student has taken the ETF standard course, the Max Lite is free and is used as a refresher for the ETF standard. And then we have two higher levels, the Max Sum, when we go deeper into the price details. With the Max Sum, we no longer use time bar chart, but we use other price movement representation like the constant range bar chart. A trader can also use Renko bar chart, for example. It doesn't matter in reality, even if the constant range bar chart produces more result than Renko bar chart. And then the ETF advanced course, when we consider more advanced concepts like, for example, correlation between pairs, using a currency meter to analyze the strengths or the weakness of currencies, how to go deeper into the news release and how to better exploit the news release, how to go deeper into the money management, the trade risk management, and how we can completely control the drawdown, for example. So, and a very detailed explanation of what we call the discretionary situations, how we can be, in some circumstances, in some specific circumstances, how we can be more flexible with our entry and exit technique. So, but the sum and the advanced level are not an obligation. They help any Max ETF standard graduates to go one or two steps further if they are interested in so. So with the Max, in fact, the trader will have a trading methodology which is based on sound concept. Sound concept because we explain also during the course why these concepts work, and many of them in relationship with what the big boys are doing. And the training we provide put a lot of attention on the price action. Of course, we use indicators, but only as a tool, as a guide to go faster in pinpointing trade opportunities or risky situations. And when I say trade opportunity and risky situation, I mean potential situations. And then with a complete, solid trading, so method with sound trade risk management and money management. And so, if you have understood what I have just explained, we strongly focus on the trade risk management, not the profit. The profit comes always after. The prime activity of a trader is to take risk, to assume risks. And because the trader must assume risk, the first priority of the trader is to control the risk. And so all the concept of the max, or many of the concepts of the max, have the aim to control the risk. And so for that, we develop the confidence at the personal level through our coaching approach. The homework we assign at the end of each training session. Chris will talk a little more in detail about the homework, and then some practice through our workshop, forum, and what we call the practice session or the scrolling parties, which are free for our Max graduates. So this is what the Max is. In fact, if you have any questions, so feel free to put them in the form, and at the end of this presentation we will of course answer to them. And now I have the pleasure to give the mic to my friend Chris. Chris?
Thank you. Hello everybody, I'm Chris. I'm based in New Zealand and I'm partnered with Craig and Eusebio in the Max trading system, and today we're offering the standard and the primer to you. The standard is our flagship course, as you've seen. We've been running this for over 10 years now, and we've had over 2,000 people trained up in the Max. One of the really important pieces of the Max is the homework. I think it makes it stand out from pretty much every other course there. So, as Eusebio said, we assign homework to you at the end of each session, and you get to mark up the charts so that we can check that you actually understood what we've said. It also makes you an active participant in the information. It's not just a PDF that's sitting in a drawer or on a hard drive somewhere, or a little video that you can quickly whip through. You actually get your hands dirty with this, and that really helps cement in the information that we give you. And it crystallizes things for you. It makes it real and tangible. It's no longer just a mental exercise. So an example of what the homework looks like is this. Most of the times we just ask you to send a chart in. So in this case, it's a simple breakout with a stop loss in place, etc., etc. And we check up pretty much on every single bar as it's going through. We really want to make sure that you do understand how the max works and how to look at a chart and how to handle it. Here's a table of the course comparisons. As we said, this ETF standard is our flagship. It has runs for about 7 sessions, actually over 7. It has over 8 different entries, and it's got a huge number of exits. Eusebio spoke about the stop loss being there. That's only for emergencies. We have a whole pile of exits that run while the trade is running, kind of trailing the price as it goes up. Remember, looking at those charts that Eusebio brought up, he was getting in at a point and then getting out almost at the end of the movement. That's how our stops work. They're really good that way. The standard has also got the profit acceleration where, as I mentioned, we're pyramiding or scaling in our, adding to our trades as we go. And as Eusebio said, counterintuitively, the more that you scale in, the less risk you actually end up with. So a lot of people think that they can do this and they end up with a huge amount of risk before they get out of the trade. With ours set up, within a few bars, you can be in a risk-free situation and have guaranteed profit. With the standard, the same movement as Eusebio was showing can increase your profits between, well, say 30% to over 300%. I know that sounds as if it's an exaggeration, but time and time again it happens. And if you sit down and just follow a trade through on a nice movement, doesn't have to be that large, you'll see what we're actually talking about here. The ETF primer is, as Eusebio said, it's just there to give you a taste. It is profitable, but definitely not as profitable as the standard. It's only got a couple of entry, it's got a couple of exits, so you will be missing out on some of the profits with the primer. There will be some trades that will move nicely that you won't be able to get into. There will be some that will carry on after you've gotten into them that you would have gotten out of. That, so it's not as profitable as the standard, but it is still profitable. There's no profit acceleration in it, and it's essentially a buy and sell method. And the money management, like I said, is simple, but it's effective, and it will keep your account intact so long as you follow the rules. Those are the courses that we've got. Just to round up on the courses, they're very detailed and precise. We find the setups. We've got a whole pile of rules for those, and the setup, like I said, is the pattern, but it's also based on the global information that's going on around you. Like, you wouldn't want to enter into a trade right before London Open, because lots of crazy stuff can happen at the London Open. So you've got to be really careful there. Once we've found our setup, like an entry or an exit, then we execute within 1 to 4 pips on a 5-minute chart. And we scale that up and down depending on what time frame you want to trade. Like I said, once the course is finished, you'll be invited to the forum. There's more videos and Q&A and stuff like that in there. To get in on these courses, the standard, ETF standard, it runs for 7 weeks, starts June the 14th, and the normal price is $2,999, but we've got a webinar special for $2,399, so a nice discount on it. Or if you want to take all 3 courses, like start from scratch, so you do the primer for 1 month, light for another month, and then the standard for pretty much 2 months, 7 weeks. That's 4 months worth of training. You can get all 3 courses for $2,679, but you will be also invited to whatever scrolling parties are kicking in at the time and that are applicable to you. And you get all the homework and you can ask whatever questions you like. So we do our best to make sure that you're really well set up for your trading side of things. And the primer is for people that just want to kick the tires and see if we're legit or not. It runs for 2 sessions only, though. Like I said, it's only a couple of entries and a couple of exits, about 2 weeks of learning how to do it safely. The normal price is just over $300. The webinar special is $159, and if you wanted to take the primer and light, it's $759, and the link for it is at the bottom of the page. So if you just wanted to try us out, the primer is the way to go. If you are serious about trading, then the standard is the option to take. Carl asked a question that the US Forex brokers don't offer futures in here.
Because the max applies to any types of market, you can apply the max with the futures market. And so, especially with NinjaTrader, or TradeStation, so we have most of the indicators we need within the max for these two charting and trading platform. And so there is no problem at all to open an account with a futures broker and to use either Ninja or TradeStation. By the way, I intend in a near future, probably this year, to make a presentation of the max with NinjaTrader. So because I have myself NinjaTrader, NinjaTrader 7, but I will try to use NinjaTrader 8 because NinjaTrader 8 is way more powerful, as I can see, and so. But it requires some preparation. But there is no problem to use at least NinjaTrader 7. So. But the tools are available with NinjaTrader 7, indeed, Carl. There is no problem for that.
Okay, I think we've got the bias for 8 as well, Eusebio.
Ah, fine.
Yep. Okay, cool. So, yeah,
and by the way, when you open an account with some US broker, for example, NinjaTrader, precisely because NinjaTrader is not only a charting and a trading platform, NinjaTrader is himself a broker. You can access as well as the futures market and the forex market. So, which is not the case for every US broker. So, but there are several excellent US brokers using NinjaTrader, of course.
Okay, and so that's Carl with the futures. Lawrence has asked, what if I'm unable to attend on Tuesdays? There's no problem, Lawrence. Like I said, we supply the videos, so you're able to go through you can watch the videos afterwards. In fact, if you speed the videos up, it doesn't take as long as a live session, and you'll still get just as much out of it. Makes available for Ninja. Yep. Okay. Sorry, there's just some stuff off the screen here. Will I be able to start making money with the primer or light packages? Waisel's asked that one. Eusebio, do you want to answer that?
Yes, indeed, the Max Primer and the Max Light are profitable, as not as much as the Max Standard, of course, because they provide only one way to open a trade, no scaling technique, and so just one MX and one XXX, so one partial exit and one final exit. But they are profitable with the same winning rate. So then the Max Standard, by the way, but the Max Standard is way more powerful because of the scaling technique and because we go also deeper into some of the concept linked to the global context. So yeah, many more opportunities and a higher comfort to trade specific situations. So. Okay,
thank you. And for those of you who have taken Primer or Light and want to upgrade to Standard, just contact Craig. He'll be able to help you with doing that and let you know whatever discounts are applicable to you. So there's no problems. And you can start the courses pretty much at any time that you like as well. Okay. Can I do monthly payments? Yes. Yes, you can do monthly. Just let Craig know. He will sort that out for you. Are there any extra costs involved over and above the courses themselves? The answer to that one is no. Everything, the prices that you get there are for the course and all the setup. There's nothing else that's needed. Okay, thank you. I know we've gone way over time here, but we've got a couple of other questions just to answer. The first one is, do we have any systems where we don't have to sit in front of the computer all day? I don't want to trade one job for another. And so the simple question is, no, you don't have to sit in front of the computer all the time. Eusebio was showing mostly the 5-minute charts because mostly the profitable ones, they've got the most action and generally tend to have the trends in them. But you can still trade the higher time frames, and the higher time frames have got a better win rate than the lower time frames, simply because the higher time frames don't have as much volatility, like the news isn't sort of slamming them all the time. And with the higher time frames, you can actually trade more pairs than you can on the smaller time frame.
Yeah, and with the higher time frame, for example, once you have made an analysis, let's say you make an analysis once a week or every end of the day, it can take a few minutes per pair. You can define, in fact, alarms, alerts. You can ask for these alerts to send an email or an SMS on your smartphone, just to keep you informed that something interesting may happen, and that at that moment when you receive the SMS, to look on your chart what is happening and possibly take an action. So with MetaTrader you have some possibilities, so some tools which may help you to optimize the time you spend in front of your screen, and so to have less time to spend in front of your screen. But we indeed, as Chris has mentioned, we use most of the time the 5-minute time frame, because the 5-minute time frame in a short period of time shows many opportunities. Smaller the time frames is, more opportunity you will have, but more difficult it will be to handle, because you need to be present in front of your screen. So, okay, I just would like to show that counterintuitive approach of the scaling technique, but I will not show on the chart because I don't have a simplified chart. I will show simply here a synthetic result. It was an example of a trade on the pound Kiwi. The date is not important because it was a very ample movement with many scalings, and we don't have such movement every week. We have such movement once a month, once a quarter, for example. So it was a trade starting with a specific entry setup, and along the trade, which has lasted during the European session. So there has been 37 steps for the trade from the entry to the final exit, and with a total number of 13 scalings. 13 scalings, which is exceptional, don't get me wrong, this is exceptional. And 13 MX, and then a final XXX with 13 opened units. And so you see on this chart here, 3 lines representing the evolution of the trade. The blue line represents the result of the trade at each step along the trend should the price hit the stop loss. And of course the stop loss is adjusted along the trade. And sometimes one unique decision is to adjust the stop loss. Some action is to make a scaling and adjust the stop loss. Some other is to make an MX and adjust the stop loss. So the blue line represents the result of the trade if the price hits the stop loss. And the yellow line represents the result of the trade at any moment if the trade is closed on the present price. For example, on this step here, should have I closed the trade at that moment, so the profit would have been 35%. But if the price would have hit the stop loss, the profit would have been around 14%. And so you can see that the most dangerous steps of the trade is always at the beginning of the trend when there is still a risk. So a result below the 0% level, so below the break-even level. And so during these first steps, the result can still be negative. After some steps, which is variable from some movement or another, we are risk-free and we are even locking more and more profit. So, for example, 5%, then 15%, then 25% at the end of this specific trade. So the result with a risk of 1%, so the result has been 66% profit. So, but again, this is an exceptional result, but the aim is to illustrate how the risk can be eliminated in such a way to have a risk-free and even sure profitable trade, and to show this intuitively difficult to understand or to believe, so that adding more scalings, if we have the appropriate trade risk management, so the position does not become dangerous, of course. And we can show plenty of such examples so with the max. So this is the power of the scaling technique.
Okay, so let's wrap this up here. We'll leave the page up for just a couple of minutes afterwards while we go quiet here. But if you have any questions, please let us know, and we'll be sending out links to all the free stuff that we've just spoken about, the the news watch list, the price levels. What else have we got? There's a non-farm payroll training live session with Eusebio coming up this Friday as well. You've probably received information about that, or you're about to get information on that. And anything else coming up, Eusebio?
No. The non-farm payroll next Friday, and then we have the course starting the week after. So.
Okay. Right. Okay. So thank you very much for staying in here with us, everybody.
I would like to take the opportunity to thank you very much for your presence this evening for me, afternoon for some of you. And so it's always important to respect the time you invest in these presentations. So I wish you a great rest of the weekend, and play safe if you trade next week, especially Friday with the non-farm payroll. I will leave the room open for 5 more minutes. We are now at 10 minutes from the top of the hour. In 5 minutes, I will close the room so that you can have time to take some notes if you need, for example, our contact details. So feel free to contact us through email or through Skype if you have any further questions. So, and that being said, so bye everyone, and take care.